Welcome to the first video of Fly in the Ointment in English. We would like to know where the market will be next year. Predicting the market is very difficult, but let's give it a try. It looks like we are in the late stages of a multi-year bull market. And we may be up against a very severe correction in the next few months until sometime next year, when there will be another buying opportunity. The two most important developments have been the continued weakness in commodity prices in the last few months, especially energy, and the continued collapse in bond yields. Now, these two developments are not a great sign of an economic recovery, are they? At the same time, while the indices continue to make new highs from time to time, fewer and fewer stocks participate. Fewer and fewer stocks hit new highs, which is not a healthy sign. Take the NASDAQ 100. It's 100 stocks, a lot of them technology, which made a recent 52-week high, but there were only 36 stocks that hit new highs of the 100. It's not a sign of strength when such an index is dominated by one stock like Apple. Now, a typical uptrend consists mostly of something like 5 waves before it peaks. And amazingly, most asset classes are in wave 5. So it's always hard to time the peak, but we're getting there. If you look at Europe, which has continued to underperform, it's just rebounding from a sharp correction before a further correction in the next few months. The chart of the Euro Stoxx 50 looks awful. If you look at emerging markets, they're also in a temporary bounce. Many country indices have already peaked. And the China index is in wave 5. So if you chase Chinese stocks while they look like breaking out, it's the last phase before a continued downtrend. Look at copper. Copper has had a serious breakdown and is telling you the real story of China. Then, of course, Japan, where everybody was positive some time ago. But the underlying trend in Japan is negative. It looks like it stopped out in July. All rallies seem to be selling opportunities. And it may well be that a topping out process is longer lasting, is very complex. And of course, not every asset class peaks at the same time. Not every group, everything peaks once after the other, and that makes it not easy. But we can conclude that you have to be very defensive. But of course, people wonder, what shall I do with my money? Bonds are expensive. Stocks are expensive. Do I have to put it in cash? Well, sometimes cash is not a bad idea. But it's obvious that bonds have acted as a safe haven, and despite the fact that yields are very low, we're already talking about possible deflation in Europe. So if you look at long treasuries, their yield is still far higher than those in Europe and Japan. So the question always is, there could be a better buying opportunity. Bonds have had a great performance this year, so it may be another few months before there is another real buying opportunity. But if we look further ahead, where is the big risk? The big risk is not of rates going up, except in very exceptional circumstances. But the risk could be a slowdown, a recession, and of course, big earnings disappointments. So the risk is in stocks, just like the risk was in commodities. These are risk assets, and they should be regarded with utmost caution. Yes, there will be another buying opportunity, but it may be a year from now. But that's for traders. We may have to be very patient in the next few years in order to get a return in risk assets, or in any other assets for that matter. But who cares if inflation is much lower than it is now? The most significant part of the commodity index is the energy complex, like a third. Will energy prices go up? Maybe geopolitics will push it up for a while. But if energy prices and food prices go up, that is an extra tax. It would further slow down the economy and it would be just a temporary bounce. However, if we look at food prices, wheat and grains and sugar and a lot of these soft commodities are in a free fall. And why is the oil price not much higher despite all the geopolitical uncertainties? Well, markets have a better feeling of what's coming than most economists or traders. The bond market and the commodity market have been telling us for some time there is a huge slowdown ahead, which is structural. This time cannot be compared to any other time. We're coming at the end of a 50, 60-year growth cycle with peak debt that is slowing us down despite low rates. And at the same time, a lot of Western countries are graying. So the graying trend makes for less growth. But all in all, it's the lack of confidence in the future that prevents the world economy from taking off. That's why there are a lot of cash on the sidelines. And one of the reasons stocks have performed is that there was a lot of financial engineering, buyback of stocks, mergers and acquisitions, even purchases by central banks. This is all temporary. Even if the market would focus on the top 50 companies in the world and drive them up on the basis of higher price-earnings ratio. We've had that before in the 70s, the Nifty 50. That is still the hope of the bulls. We cannot exclude that. It could happen. It could happen later, for example, somewhere in next year. But there is this consensus that this could happen, and then it may not happen, because the fundamentals will not justify such a move. Yes, so cash looks like the most attractive investment right now. You have to be patient, because some things will go up and you will have the feeling that you've missed the boat, but you have to look at the big picture. What does the world look like a year from now? And it looks like a year from now everything will be lower than it is today. Now, this is the end of the first video. Till next time.